Hey everyone, Douglas here, Candid Market Analysis, and today I'm going to be taking a macro look at the dollar index. Now, while equity markets have been on a wild ride for the past 6 weeks or so, the dollar has quietly been flying under the radar and has been putting in some new highs for the year. So what I want to do in this video is take a look at one of the main macro drivers of the dollar index and kind of piece together what that's telling me. So if you like this video, make sure you hit that subscribe button and click the notification bell so you won't miss an update going forward. And don't forget to click the thumbs up button on your way out as well. All right, so I've been pretty bullish on the dollar since the earlier parts of this year. I've been effectively long the dollar index since that breakout in late April earlier this year. The main reason for my bullish stance has been the dollar shortage thesis. In short, there's a massive amount of dollar-denominated debt worldwide. We're talking trillions upon trillions of dollars, and there just simply isn't enough dollars to meet the demand to service that debt, and therefore we're seeing the dollar rise, especially in the face of rising interest rate and rising volatility, driving that dollar demand. And what I want to do in this update is show kind of how you can take a macro hypothesis or theory like the dollar shortage theory and try and build a real macro case to test that hypothesis, and then see if you're able to find evidence that can kind of corroborate that theory and how you proceed with it. So the first thing I want to do is try and come up with a market or some sort of indicator that could or should be correlated if we're correct in our thinking here. And an example of this might be the real interest rates in gold that I looked at a couple weeks ago here on the YouTube channel. Or another classic example of this is interest rates in oil. Interest rates oftentimes following inflationary drivers, oil being that inflationary driver. Therefore, you oftentimes see those correlated. But for this instance here, with regards to the dollar index, we're going to have to be a little bit more discerning in our thinking here. So one really good place to start this thought process is to follow kind of balance sheet operations and taking that perspective. And what I mean by this is thinking kind of assets and liabilities. In other words, if our theory is that there is too much dollar-denominated debt, that would mean that there is a problem on the liability side of the debtor. So the solution would be to raise cash on the asset side in whatever currency that can happen in, and then convert that into dollars. And if we only focus for kind of the rest of this, for the purpose of this idea on sovereign debt, on the sovereign debt side of things, that'd be the kind of public national side of things. A country would do this or accomplish this raising of cash by selling bonds. So if we're right in our thought here, we should see some correlation between sovereign international bonds and the dollar, because again, as that volatility and interest rate rise, the cost and risk of borrowing in these countries should be rising as well, pushing down the bond prices, especially if there's some sort of pegged or backed currency, or if they have or if they're under some sort of mandated fiscal constraint, such as the Eurozone being an example of that. So here's what I want to do. I'm going to overlay this dollar index chart with BWX. Now, BWX is an international bond ETF, and the very first thing you should notice is a very precise inverse correlation here between BWX and the dollar. The next thing I want to do is go ahead and invert the dollar, okay? And this is going to just give us a more clear example of exactly what I'm looking at. So again, as you can see, there is a very obvious correlation here between global interest rates and the dollar index. But correlation does not prove causation. But since we've already thought through kind of the causal mechanisms of this relationship, and being that the correlation is very precise here, we can feel pretty confident that there is some sort of causal relationship. So What does this do for us? Well, it allows us to look at other leading indicators and make assessments based on those leading indicators that we can then derive some sort of directional probability of global bond prices from those indicators. Now, there are obviously many data points that we could look at here, but since BWX is a very heavy Eurozone bond, let's look at one recent Eurozone data point that just came out, and that would be the Eurozone manufacturing PMI number here. And as you can see, the Eurozone is having some major issues with growth right now, and the manufacturing PMI is plummeting towards that 50% or that 50 level, meaning there's an ever-growing probability of recession in the Eurozone, which in turn means that we should continue to expect risk and volatility to rise, putting that upward pressure on rates and downward pressure on bonds. So what does this mean then? Should we assume that the dollar is going to shoot straight up from here? Well, not necessarily. There are obviously many other inputs to consider and many other macro drivers as well. But obviously, there's a lot to say about global bond prices. But what this does do is it helps me build a probabilistic bias. So when I go to my next step, which is to really overlay the chart, the dollar index, with that Elliott wave count, and if I turn that off and flip this back, and I'll show you the count real quick. As I go to that next step, which is putting this count on there, I can already have some sort of direction and some sort of macro probability in mind that will help kind of guide my technical analysis. And that's what this is really all about for me, is building up probability and using every data point that is available to me and thinking soundly about the implications of that data and building precise models and then pairing that with a very strong technical tool like Elliott Wave. And that's going to give me a high probability roadmap of kind of what lies ahead. And that's I mean, you can't really ask for much more than that when you're trading. All right, so that's gonna wrap things up for this look at the dollar index. Hey, if you like this type of process and you like what I'm doing here, I'd love for you to check out my Patreon page. I have multiple updates from both a macro and Elliott Wave perspective, covering all the major asset classes posted there each week, and this is the type of research that I'm providing week in and week out to all the subscribers there. So if this sort of thing intrigues you and you want to grow in your knowledge and you want to understand how the markets operate at a deeper level, definitely check that out. But until next time, everyone, good trading, and we'll see you then. Bye-bye.